Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we've got Matt Mason of Certus Property Consultants. Now, he's with us. He's a valuer, has been in the industry for a long time. He'll introduce himself in due course. And in that, we cover loads, really, to be fair. Probably too much to list here, to be honest. We spent quite a bit of time talking around investment valuations and how they differ and the nuances and when they are used and not used and when it's appropriate and so on. So that's really interesting. We get a load of conversations around that. Valuer packs, what does he think of them? I think you'll be interested by his response to that. HMOs, multi-unit freehold blocks, talk about auctions, talk about future outlook and how that impacts historic data and everything in between. It's a good hour, plenty to cover off, and hope you enjoy. Hello, and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode, we've got Matt Mason, who's from Certus Property Consultants, and he's here to talk to us or help us navigate the world of valuations, specifically from the investor side of the conversation as opposed to homeowners. So, Matt, welcome.
Thanks for having me, Mark. Yeah, glad to be here and to try and pass on whatever advice I can give. I know valuers can be a bit, I think, rigid and not be open to providing advice. So if I can provide any or pass on anything to any of the people listening today, which helps them, so be it, and good.
Yeah, fantastic. No, thanks very much. I appreciate that. And, we've just been chatting a little bit around what we're going to cover in this episode. And I think it's fair to say there's so much nuance within valuations. We could probably do multiple podcasts on this and still not get to the bottom of it to help our listeners understand it in full detail. But then I guess that's why you study as long as you do to become certified as a valuer. So before we get into the detail of it, do you just want to give us a quick précis of your history, background, how you ended up where you are, etc.?
Yeah, so I graduated from university in 2006. I went straight into work at Dawson's in Swansea, covered sort of general practice surveying. And then I qualified as a chartered surveyor in June 2010. And from there, then I grew the valuation department. But being in a general practice, it was quite good that we sort of learnt pretty much everything from agency through to auctioneering, landlord and tenant and valuation. So it was a good basis on which to start. And then from there, I grew the valuation department, and in September 2022, helped set up Certus Property Consultants. At the time, it was just two of us, but now I think we're up to about 17 or 18 staff. So the growth has been good. Certus, we're a national company, and we pretty much, the majority of our work is secured lending, commercial secured lending valuation work for the banks, yeah.
Awesome. Thanks very much. So, looking forward to this. As I say, valuations, when they go the way that you want them to do, great. They sort of sit around in the background, tick a box, and on you move. When they don't, that's when understanding all of this becomes imperative. And I guess the main point from our perspective, why we're really talking about this, is just to try and educate investors as to what can go on in a valuation report. The rationale for it is that if you are trying to predict something in the future, which is what most property investors are trying to do in order to predict what the returns are going to be and so on, especially if they're going to add value to it by refurbing it, splitting titles or whatever it's going to be, you want to be able to have an educated guess as to what that outcome is going to be to the best of your ability. So that's the rationale behind this. And the more information we can impart on that, we'll never give them the actual formula, but at least we can help them understand, the nuances, as I say, that do sit behind all of that. So Quite a few points to cover off today then. Should we start off with VAS panel, which is relatively new, I guess, in the world of surveying. So for those that aren't familiar with what VAS panel is, they manage valuers on behalf of the lender. So it can be an arm's length third-party instruction rather than a lender having a closed panel of 1, 2, 3 different lenders. Gives a variety and also takes away the headache of managing that relationship. So how do you find VAS, and how has that changed or influenced the industry since it came along? I appreciate they're not the only providers, but we'll use VAS as an example.
Yeah, I mean, VAS are brilliant. We work very closely with VAS panel. Know Stephen Todd very well. I think he was on your podcast a couple of weeks ago. Yeah, I mean, there's a lot of smaller lenders, not just smaller lenders, but I think that the thing that VAS panel give these lenders is national coverage. So they have valuers all around the country. For instance, if we look at South Wales, they would have maybe 5 or 6 valuer panel firms, and lenders don't have that direct access. So you may have lenders, for instance, if you look at Together, based in Manchester. VAS take the lead in terms of the panel management. They know the valuers on the ground and work closely with those valuers and provide a sort of an instruction to audit, service, manage the payment of fees. And I think lenders really like that, and VAS are brilliant what they do. Yeah, so they're one of our biggest clients in terms of the panel providers that we work with, and they're really good from a value point of view to work with. I think that one of the key points is we work with a lot of panels, but their auditing process is pretty stringent. Sometimes not from a valuer's point of view, can be a bit frustrating sometimes. But I think from a lender's perspective, the lender's getting a thorough report which has been checked at QC by the VAS panel team prior to going with the lender. So we get a lot of feedback from VAS in terms of our reports. It's a learning process, obviously, but that's one of the best things that the VAS panel do is that their quality control in terms of looking at reports and QCing them before they go to the lender.
Yeah, and I guess from a lender's perspective, they issue the instruction, it goes to VAS, and then they don't get involved until the valuation report comes back. If there's anything to be contested, then they don't get involved in that process either. That goes back to VAS. They do their piece back to the valuer and so on. So they get a ready packaged final outcome without all the in between stuff that goes on from that perspective. The other thing we're seeing as well is that it gives the borrower a degree of influence. I wouldn't say control, because you can't control the valuation, but you can influence. And what I mean by that is we often advise borrowers, if there's anything that's quirky in the deal that means that it's non-standard for whatever reason, it'd be a large HMO, you want to understand how the valuer potentially is going to approach its valuation, aside from the valuation instruction. We'd encourage the borrower to go and speak to local valuers, understand if they're on VAS panel, strike up a relationship, have a conversation around it. Does it make sense based on what they're trying to achieve, etc.? Have a general conversation around it. And that means then when we work with a lender who is using VAS, that instruction go out. And once you get a list, you get a list back of a number of different valuers. And the idea being is you would pick the one that you struck up the relationship with. Is that something that you guys see a lot of?
Yeah, we get calls all the time from prospective borrowers, saying that they've been given our contact details from a broker or from VAS panel. We could be one of the firms they choose. And we're more than happy to have that conversation about where the market sits. One of the questions we get is, what methodology would you be using if we're valuing this asset, this property? And I think they want that peace of mind, because valuation fees aren't the cheapest these days, especially for commercial red book valuation reports. So I think before they part with their hard-earned cash, they want to speak to the valuer just to have a conversation with them, just to get a bit of feedback on them and where they think that the value may sit. Ultimately, obviously, we can't provide any advice which can be relied upon until we've obviously been out there, and ultimately the lender is our client. So we can't ultimately go promising that we're going to do X, Y, and Z. And it's important that obviously we keep our independence, but we're more than happy to have the conversation with borrowers or brokers and provide them with advice, just generic advice on where we see the market, etc. That if that ultimately gives the peace of mind to the borrower prior to us getting the instruction, then so be it, and great. And hopefully that puts us in a position to win more work, given that we're open and willing to provide that service. Because like I said at the start, I think the surveying industry is a bit rigid. I think historically surveyors or valuers haven't been prepared to open themselves up and provide advice to people who aren't their clients, shall we say. But ultimately, I think, the valuers, we're just a cog in the chain, and we're not that important, should I say, but we're there just to do our job. And yeah, if we can help in any way in making the process smooth it is for our client as well as obviously everyone else involved in the process, then great.
Yeah, I know. No, and I think whilst you say a cog in the wheel, I think there are many cogs to the wheel. We as brokers, the borrower, the lender, the legals, so much can go wrong at the legal stage as well. So we're aware of that. But I think, as far as the importance of something, the value clearly is a big piece of that jigsaw. And for some people, it's not so important. Those where they've got existing borrowing, certainly where they've got bridging lending and what have you, it could be catastrophic if the number doesn't support where they anticipated it to be or that sort of thing. But again, we'll come into why that may or may not be the case as we go along that front. So that's good to know. In regards to the VAS perspective as well, is there, and you mentioned that you couldn't obviously commit to anything. So I guess the advice to potential borrowers or potential clients are that just don't go and ask what's the value. You really want to have a conversation around, look, I've got this property, there's this going on with it. Let's take a large HMO, for example. A large HMO, I'm looking for an investment-led valuation methodology. This is my assumption. One of the questions we get asked a lot is, what yield should I use? Okay. Now, a lot of people default to 10. Which I get why they do it. Is we rarely see them at the 8s, but we sometimes see them at the 12s, 13s. So 10 seems to be somewhere in the middle, as a point of reference. How would you encourage the potential borrower to have that conversation with you, as I say? Because just coming up and say, do you think my value is correct, is not the way to approach that conversation.
No, I think understanding the method that the valuer would adopt. I think the HMO, adding the HMO part is quite good in terms of the methodology which valuers adopt is so important to the end value, especially when consideration the asset type such as HMO, because we know obviously if an investment approach is adopted with rents as they are at the minute in this asset class, then it's generally perceived that the market value or the market value based on an investment approach will sit higher than sort of price per square foot C3 values locally. So I think the question would be to the valuer, look, it's a small HMO, 3 to 6 beds in this location. Obviously, we know in Wales it's an Article 4 direction, blanket wise. So in this location, so it would need planning. What the methodology, would you use an investment approach? I think that's a key question, is what's the approach that you're going to use? And we get asked that quite a bit. And then ultimately, a valuer who undertakes HMO valuations will be able to tell you what the yield adopted would be in certain areas of Cardiff or Swansea, and can give you a wide range of yields. So, for instance, if you said to me, or someone called me up and said, I've got a property in Roath. It's 6-bedroom, all en suite, recently refurbished. I can tell you exactly where I think the rent would sit and where the yield would sit at, based on the fact that I've probably undertaken 2 HMO valuations in CF24 in the last month. So, those questions, what's the methodology? Where do you see the market currently? And what's the adopted yield? You're not then specifically asking the valuer what they're going to value the property at. You're just asking them to confirm roughly where the market is and the method at which they're likely to adopt. I mean, whilst we're on sort of HMOs, I think ultimately, guidance, it's quite a grey area on how HMO should be valued, because we understand that the way rents have been pushed, and I think in Cardiff I've seen rents up towards sort of £180 per calendar week per room. That's pushing 6-bed HMO rents up towards sort of 60k per annum on a gross basis. Now, if you've got a multiple of 10, say, and a gross yield of 10, which is broadly where yields sit in Cardiff, maybe 9.5 to 10, you've then got potentially a terraced house, which was formerly a 4-bed at 10 times rent, 600k. So I think that on small HMOs, guidance from, say, Shawbrook is that you should, an investment approach is fine, but I think there's got to be an understanding of where C3 values sit. Because if you look at Cardiff, for instance, and I've undertaken HMOs in a load of HMOs in CF24, but in CF24 you've got Roath and you've got Splot. Now, the difference in C3 values in the two areas is it could be £300 a square foot down to £200 a square foot. So it's understanding where your bricks and mortar values lie, because if your investment approach, for instance, based on a 6-bed HMO at gross yield of 10%, delivers a market value of, say, 600k, but your C3 value sits at, 350 to 400k, there's going to be a softening of that value, or there should be a softening of that value by the valuer. In a better location, maybe if you consider Roath or Llandaff or somewhere like that, then there's less of a divergence between the two figures, and therefore it's normally accepted that actually the investment approach alone with no softening of the value or yield is acceptable. So I think understanding, where yields sit, but also, especially if it's a small HMO, 3 to 6 bedrooms, valuers should be using a cross-check, a C3 cross-check to confirm that actually that investment method does not sit way above the parapet in terms of local C3 values. So I've gone off on a bit of a tangent there in terms of...
No. Well, we're going to cover... it's a perfect segue into commercial or investment valuations. So, and interestingly, you mentioned Shawbrook because we've had them on the podcast as well quite early on, actually, in the episodes. And this was a huge topic of conversation. And HMOs and its investment value is something that we come across every single day of every single week. And, their take on it was, and interesting, it's interesting you mentioned them, is that gap is, it may have, if the cost to convert that £300,000 home into a HMO, notwithstanding the Article 4, was 50k, but yet you're trying to value at 600,000 because of the income and the yield, then what's to stop the person buying the house next door and converting it into an HMO? Now, Article 4 comes into play, which is arguably the mitigating circumstance to that. Outside of Article 4, you'd go, well, actually, it's not going to command that premium because just do it next door for £250,000 less.
And I think that's important. And you can look at Wales in isolation, really, because of that blanket Article 4. And I did an article for Business News Wales on the HMO market in Cardiff, and it looked at how the market is being impacted by the Article 4 and the fact that there are now saturation points in terms of whether the local authority will give further consents for HMO conversion in the Plasnewydd wards, so see if that's your Cateys and Roath areas. And effectively, most areas are at saturation point. So it's not as simple as buying the house next door and converting that, because effectively you won't be able to. So there is that bit more of a premium added to planning in Wales. But for going back to Shawbrook are the only lender that I'm aware of who will provide guidance on how they wish for a HMO to be valued. That guidance is for the listeners. So there's 4 ways. So in a non-Article 4 direction, a 1 to 3 bed HMO, purely a C3 valuation. In a non-Article 4 direction, a 3 to 6 bed HMO, still on a C3 basis. So that obviously excludes Wales because we're in an Article 4 blanket direction. But if you've got listeners in areas of inner city areas where there is no Article 4 and they have a 6-bed HMO and they've done all the adaptations, it's got 6 en suites. The guidance is from Shawbrook, and obviously it's down to value of discretion, but the guidance from Shawbrook is it should have effectively be undertaken on a comparable C3 approach, because anyone, like you say, anyone, and like Shawbrook said in their report, look, anyone could buy the house next door and do the same conversion. And I think therefore that value is effectively going to reflect the cost as they see, or the cost to buy it plus the cost of undertaking the works. And if you bought it for 300 and you spent 50k, it may be 350 plus a small margin. And then more relevant to Wales, the third way in which they state that they wish for HMOs to be valued is obviously Article 4, and a 3 to 6 bed HMO, which will, as I discussed just now, is accepted that an investment approach is undertaken, however, with a C3 cross-check. So it's important that borrowers, brokers understand where HMO sits in the market, what the local market is like, what are the houses on the same street selling for, if there's any C3 dwellings on that road, what's the tone of them? And if the gap is large, or the gap is too big between that investment headline figure and your C3 value, then that should be looked at by the valuer, and it could effectively soften the yield and the market value. And then the fourth one is sui generis HMO anywhere in the UK, regardless of Article 4, because planning is required anyway. And I think Shawbrook's guidance says investment approach is acceptable, subject to obtaining good and reliable investment evidence. And that's the caveat at the end of that is HMO evidence is difficult to obtain. I mean, as you're probably aware, the HMO market is full of now newly refurbished, good quality ensuite rooms. They've moved on from the old student digs that they used to be. But once they've been converted and the cash flow and the income is so good, they're never sold. So the only time we see HMOs come into the market are effectively if they're in a distressed sales situation or if they're vacant. So there is limited yield evidence. There's enough, having done Swansea and Cardiff recently, there's enough to sort of get a gauge on where yields sit, but it is difficult, yeah.
Yeah, no, interesting. And, HMOs are a topic of conversation that we have a lot. When you talk about buy, refurbishing and refinance, a lot of people are looking to acquire, uplift the value to recycle the capital, and then hopefully secure this investment valuation. So it's really interesting to hear how that comes about. And also it's refreshing to hear that, speak to us about, we should know what the local yield is. We get the question all the time is, what is the yield for the area? Well, A, I haven't got a clue. And B, I don't know where you find the information from without speaking to a valuer. So just go and speak to a valuer. Now, whether they're forthcoming with that information or not remains to be seen. But
yeah, there's no reason. It's public. There's no reason why a valuer shouldn't be open to where yields sit. It's public information. But for the benefit of the viewers in Swansea, the last few that I've done, I think the last few sales I'm aware of for good quality HMOs, broadly between 10 and 10.5%. Cardiff, you could probably harden the yield. Used to be able to harden it by about 1%, but I think the most recent sales, there's a couple in Catay's around 9.5%. So then you can adjust from there, depending on the quality, depending on its specific location, and obviously considering where the C3 value sits locally, if it is a small HMO.
Yeah, and I think again, this is just for the purpose of for the benefit of the listeners, is don't get your divides and your multipliers mixed up. So 10 just happens to work both ways, whether you divide it or multiply it. So 9.5 is actually a better value than 11 is. So just make sure you divide that number, not multiply, which you've seen a few times. So yeah, just to be careful of that one. So on commercial investments, I think we've covered HMO pretty extensively there, but HMO is not the only type of property in the residential space that would lend itself to investment values. Blocks of flats being one, which may lend itself to that. Mixed use properties, possibly, plausibly. What sort of experience, or what would you say are the more common instructions you get where an investment valuation is appropriate on a residential property? So
the valuation of MUFBs is becoming a pretty hot topic at the minute. And actually, I've done a couple of recent presentations, and I used to do the valuation of HMOs because that was the hot topic. But I switched it. The last one I did at the Property and Problems event was the valuation of HMOs. The valuation of MUFBs. Because as valuers, what we're seeing is that a real appetite for lending against a broken up or aggregated value. So we're seeing blocks of flats instructed to us where the estimated value is provided on the basis of individual values of the block, which is fine, that's okay. And there's quite a bit of discussion around, well, should that MUFB or should that asset be valued on a single lot basis using a yield approach, or on the basis of the brokered up individual aggregated values? Now, I think both methods can be used, but ultimately it depends on where the asset, where the property is and what the market is like. So, and as valuers, I think we've also got to consider the fact that we're acting for the lender. So say you've got a 5 or 6 bed, 6 unit MUFB, so 6 flats in a block. We know that in a recovery position, and which is always the fallback that us as valuers have to look at, because obviously our neck's on the line that if it's repossessed, the block, how will the lender dispose of it? And I can guarantee you, in most situations, the lender will look at recovering their debt as quickly as they can. And that is not to sell 6 individual flats. That is to sell as an investment, as a single lot sale. Now, there are some circumstances where I've undertaken valuation of MUFBs and the market is so strong locally that it would support the sale of multiple units and it wouldn't oversaturate the market. And therefore, that's the time to achieve those individual sales isn't significantly different than the single block marketing period. And given that the aggregate figure is higher, it's reasonable to assume that that's a fair approach to value. But what we're seeing is, especially from some lenders, I think Quantum used to maybe allow an aggregated approach or request that we provide those figures, is we're seeing people hanging their hat, or borrowers and sometimes brokers hanging their hat on refinancing on an aggregated approach. And I can guarantee 9 times out of 10, a good valuer will come back and say that's impractical. You need to, the lender should be relying upon an investment approach or a single block sale. Now, how you determine that single block sale is up for discussion. I know my colleague Sophie undertakes these types of valuations in areas where there aren't any investment sales. So sometimes we'll look at it on the aggregated value and then a discount for the block sale. In Swansea and Cardiff, there is enough evidence or yield evidence that I can determine what that an MUFB yield is 8.5 or whatever, 9% in Cardiff or Swansea, and can provide that figure. But ultimately, it's up for discussion at the minute. And as valuers, I'm sort of I get the call from brokers sometimes and saying, look, what are the individual flat values or unit values of this block? It's going to be going to Together or Shawbrook. It may be coming your way. And I go, whoa, wait a minute now. Don't hang your hat on the fact that those aggregated values, you're going to be able to leverage against those, because there are so many factors at play when determining that it's a possible scenario to be able to borrow against. Yeah,
and it's really interesting because I'm dealing with and have dealt with all of those scenarios. So I'm dealing with one at the moment. So splitting the titles is becoming more popular. And there is a certain type of property that lends itself to as well. So not all blocks of flats lend themselves to be treated as individual units as would be perceived. You get varying degrees of quality of these flats. Now, these particular ones were a block of 14 flats. They were purpose-built flats, relatively new, and yet made sense that as individual flats, they stood on their own 2 feet, as it were. But if you take a single townhouse, for example, in Swansea, that's how it'd be converted into 3 flats, you would argue they aren't 3 individual units. They're never going to work as split titles. They'll only ever be the value of the block.
I think the important, like you say, the purpose-built block of 14 flats, yet capable of being split and probably lend themselves to that. I think the important thing from a valuer's point of view to look at is, they could be sold individually. But in reality, if you're in a secondary location, for instance, how long is it going to take to sell 14 flats? Now, I did a big scheme down in West Wales where there was 29 flats. And I was saying to the lender, I think it was Together, I was saying, well, look, 29 flats is going to saturate the market. They're going to be phased. And they could easily be split and sold separately, but it's going to take you 4 years. And bearing in mind that together lend against a VP 180-day figure, so what, that aggregate value, it's impossible to determine what that value or the aggregated discount should be. The discount should be to determine an aggregated sale within 180 days. It just doesn't work. So again, even though it's possible for some assets to be split, looking at the number of units, the local market saturation points is so important. And I think anything generally over 12 to 18 months to sell the individual units means that I think reversion to or considering the block value, investment value would be a sensible approach.
Yeah, no, definitely. And the saturation point is key as well, because again, we get, people want to buy a property, convert it, increase, sweat the asset as it were, add value by creating the number of units. Then the next question is, if you've taken, and I exaggerate here, but you've taken a standard house, and made that into 6 flats, for example. I don't know how you do it, but let's say you did it. Is there a demand for 6 flats in that particular area and so on? Just because the numbers say so, it doesn't, again, you're building a product or you're making a product, and is there demand ultimately for your product in that space? So the saturation point is key as well. I remember working on development up in Runcorn, and they were building 200 flats, I think it was, but they were all 55 and above age, so you couldn't be in there. And the whole issue with that was not the numbers. The numbers were lovely. It all worked really well. They had all the skill set to do it. It was, could the market tolerate 200 flats that could only be occupied by 55 and above? And then that dramatically impacted the end value.
Yeah,
imagine.
And the market over time would, but we know time is of the essence, and we always going to look at a position where there's a default and the lender steps in. They're not waiting 5 years to sell 200 odd flats. They're getting rid of them pretty quickly, aren't they? So that's the position and the view that we've got to take.
Yeah, no, that's interesting. And interestingly, you mentioned across the aggregates less. So the one I'm working on currently was aggregate less, 25%. Ironically, that's the one that we split into 14 units. But what we've done differently there, we've gone to 4 different lenders to work within the concentration of each of them. So we've knitted different lenders together, so exposure's less. Therefore, they have less of an issue around the 75%, and it's worked, so it's washed through and what have you. So, but that's more to do with the lender and structuring the lending more than it is talking to the values on that front. So that's interesting on that front as well. Okay, fab. And any other residential types that potentially lend themselves to investment valuations, or do you think we've pretty much covered them?
Yeah, I think those are the 2 main asset types, the MUFB and HMO, that we do a lot of valuations for. And I think other than that, yeah, I think that's about it.
Yeah, because the other one we get is, or we used to, we don't get it so much anymore, was short-term lets, holiday lets, or service accommodation,
right, yeah.
wanting the commercial values. And I know we've got the C6 classification in Wales, and England is likely to do something not too dissimilar. I think Scotland have also done something now as well, but still, it's a house. You just choose to operate it as a short-term let. Ultimately, long and short of it is, it's a house.
It should be valued on a comparable C3 basis, unless there is a restriction on use, and unless it's being valued on a trade-related basis. So, like as an operational business, it's going to always be valued as a C3 house.
Yeah, and even then, they'll probably keep it a VP for the purposes not to over-leverage the trading entity as well. So, yeah, no, that makes perfect sense. So, nice and short, I think we just need to cover that off. But yeah, it's not appropriate 99% of the time to have an investment value on that. So moving on then to the report itself, something that I've noticed a lot of, and I've always wondered whether it does actually impact the value, is so we're not talking here about the short valuation, which is just an A4 sheet that we get. This is a proper valuation report, which is, X pages long, very detailed. Every one of them has a future outlook section in there. So talking about obviously what's going on in the world, micro and macroeconomic influences and whatnot. So that's the looking forward. Obviously, we've spoken about comparables, and comparables are historic data, albeit within 6 months, 12 months, depending on what the evidence is to support. And I guess my question here is, how much does your future outlook in a volatile environment, such as the one we're in at the moment, versus the historical data, how much do those two conflict with one another to ultimately then derive the valuation?
Yeah, I mean, it's a good question. I think ultimately we can only rely upon the data that we got in front of us. And we are in a volatile market at the minute. Who knows what Donald's going to do next? But I think we can only rely upon the data. And sometimes, as is the case, the data which is 6 to 9 months old, at which we're looking at, may be slightly outdated. But I think the view that I take is that I would always be adopting the comparables, using those to determine what my headline figure is. But if I'm not unsure about how the market is going to react, say 6, 9, 12 months down the line, and obviously the valuation dates as of today's date, if the market's a bit, say, sticky and there's less activity because there's more caution around, say, from buyers, then we may, to sort of mitigate risk, whilst the value should align with where the comparables sit, I may take the view that marketing periods are, say, moved out slightly. So there's less activity in the market, less buyers around. So marketing periods, say, for a residential property, whereas they maybe 6 months previously, 6 to 12 months ago, we're now moving out to 9 months. And that may therefore impact your restricted marketing sales value. So the 180-day value may drop, say, a few percent, 5%, which is how, as a valuer, we may mitigate the risk with the uncertainty around it. Say, well, look, the evidence suggests the value is this. I'm reporting it as this, but this is what's happening in the market. We don't know what's going to happen with interest rates. We don't know if values are going to fall back, but we do know there's less activity, and therefore the marketing period I adopt is, say, 9 months, and your 180-day figure is therefore impacted slightly. So that's one thing to look out for, because we know that a lot of, obviously, the lenders in this secondary market, the likes of Together, Shawbrook, they'll lend against a 180-day figure sometimes.
Yeah, and interesting, and glad it's been brought up, really. So on a valuation report, again, I'm not talking about the one pages for the vanilla, 2 up, 2 down houses. That's pretty, we don't even see the comparables. They just tell us largely what the number is, or a very light touch. But on a normal valuation report, as I call it, the long form, we'll see several figures on the valuation report. One is the OMV, the open market value, on the assumption that you've got forever to sell it. Then you've got the 180-day, which is, again, restricted sales period 6 months, and the 90-day restricted down to 3 months. We've got investment values, and they will all be headed up accordingly, depending on the methodology that's been deployed. Now, the lender may still lend against the OMV in our experience. However, let's say, again, I'll make these numbers up just to prove a point. Let's say the OMV is 500,000, but the 180 restricted sale, because of a nuance in the local area, is down at 250. They're not going to lend against the OMV at 75% loan to value, because on a restricted sale basis, there's too much of a gap. So rather than say, we're only going to lend on the 180, they may adjust the loan to value and say, well, actually, we're only prepared, we won't do 75% on this because the gap's too big. We'll come in at 70, maybe 65, whatever it is, because that will just balance that book between the gap is too large for the lender to want to swallow.
Yeah. I think therefore it's important that valuers get these figures right, get these 180, get these 90-day figures right. It's not just a throwaway, discounted by 10% or whatever. I think some thought needs to go into it, because there's sometimes the figures that can determine whether a deal proceeds or not, or what the LTV is. And ultimately, I think historically, maybe valuers, we've just gone, 180 or 90 days, it's a straightforward 10%. But actually, I think we need to look at the asset type, what's the most suitable method of sale, what the market is like, and make an informed decision rather than just a quick percentage decrease against, because those figures matter.
Yeah, and as you say, I exaggerate the point to make the point, I exaggerate the numbers to make the point, but that is what the lender will look at. If the disparity is so large, then they will ratchet something, because there's a risk in there that may drive it also. And then one of the other things which we were talking about are on the investment value, and this was something that came to light the other day, which it only jumped off the page because the number ultimately was the same, was, again, this testing against different methodologies to sort of make sense of the figures, if I'm saying that right. So we had, the lender was lending against a VP, vacant possession, so that was the instruction, and that was the number they were going to lend against. However, within the report was also the investment yield-based valuation. And it just so happened those two numbers were the same number, so it didn't really make a difference. But it sort of emphasized the point. What the valuer was doing is saying, we don't just rely on that one number, we then make sense check against a yield based, a 180 and 90, and do all of these numbers sort of make sense in the scheme of what the valuation report is trying to depict. Is that fair to say? So that these numbers are then all being cross-referenced against one another. Is this logical, the outcome?
Yeah, I think we've got to tell a story, and we've got to put in front of the lender what the property entails, what the occupational position is, and sometimes there are differences in values across market value, VP value, given the asset type, maybe longer periods to sell, and the 180 day. I think touching on that quite often there is a difference in market value and VP where there's a strong income and covenant, and I think borrowers, investors listening need to understand that certain lenders will disregard, so they could be buying or lending against a property where there is a strong covenant there is a good income in place, but certain lenders lending against VP, that value's gone. It's disregarded from, given the fact that vacant possession assumes just that it's fully vacant. But obviously, we've got to, as values, we've got to be able to justify those figures. And sometimes then there are situations, even if there is a tenant in place, that we do value market value and VP as the same numbers, and that could merely be down to the fact that there's local covenant tenants in place, and we place little value on the income itself. So investors, we sometimes comment in a report that we state somewhere along the lines of that the lease is 1 year left to run, and it's a local covenant, and therefore, if the buyer came to the market, they'd place almost no value on that income. And therefore, we'd adopt a vacant possession figure, albeit a price per square foot, or a softer yield approach to consider VP. So there are times when they are the same figures, yeah. But there's always got to be evidence to back it up and a reasoning behind why those figures have been adopted, be it the same or different.
Yeah, and this is where I'd encourage listeners to read the valuation reports. We're all guilty of it. I know the first thing I do is go and have a look at the exec summary and then what the actual value is, and then jump down to further in the report to have a look to see what's the makeup of that, if it's a HMO or what have you. And does it tick the box I needed it to, first and foremost. But there's a lot of information in these reports. They aren't just a load of paragraphs for the sake of it. And certainly just go through and have a look. There are some nuances in there. For example, one of the units that we had valued recently, there was comments on there as to how the value was affected because whilst it was a multi-unit block, it had shared utilities, which affected its value and its ability to be split, obviously, on that basis. So just read the report. It's yours. When you get it in your hand, it's about your property. Just have a detailed understanding of what's going on, what the value is seen, and so on. If you are going to challenge a valuation report because you disagree with something, there's only a few different ways you can challenge it on. One is you disagree with the methodology, and we've spent quite a bit of time talking on that. Or if there's a material error in there. I don't think I've ever had one valuation report adjusted because of methodology, personally. I have had a handful, because there's been a material issue. For example, we mismeasured one of the flats, which is about 15 square meters short, changed it by a few thousand, enough to make the deal done. So yeah, just challenging somebody's opinion when the opinion of the person who wrote the report is far more qualified than yours probably isn't going to get you very far.
Yeah, 100%. I mean, I've had a few where comparable evidence has been challenged and they present their own evidence. None of it's sold, all on the market for higher figures, not really relevant. So look, as valuers, we have access to all the most recent data available. If it's there, we use it. So I think ultimately you're never going to really be able to challenge on that basis. Methodology, you'd be hard pressed to be able to argue that the valuers adopted the incorrect method. And yeah, you're right. I think the only one potentially which you could argue. And look, values are human. We make mistakes. We can sometimes, there may be an issue with the measurements itself, or we didn't see something else at the property which could have benefited or improved value. So yeah, that's probably the only aspect that you can challenge on.
And I think, I say that because when a valuation doesn't come in at the figure you're expecting, so there's a few things. Everybody call it, well, I say everybody, a lot of people call it a down valuation. I have it's a bit of a bugbear of mine. It's not a down valuation. It just didn't meet your expectation. A down valuation to me is if you're valued at $1 million today and it's 800 tomorrow, that's a down valuation. So the fact it didn't meet your expectations isn't a down valuation. But I also empathize completely. It's an emotive subject. It can cripple the deal. It can fundamentally change it. So I understand the want to contest it. I guess my point being is, of course you can contest anything, but as a process, it's time. You've got to go away, you've got to do your research, you've got to do your homework, etc., etc. And as I say, the reason I bring it up, unless there's something material in there, if you just want to argue someone's opinion, you're not going to get somebody to change their mind. It's a professional opinion that's on paper. Yeah. Okay. Fab. So thanks for that. And then something we didn't. Two other things I wanted to cover off as well. So it's often touted valuation packs pulled together by investors. What are your thoughts on them? Are they useful or a help or a hindrance?
Yeah, absolutely. I mean, the amount that you wouldn't believe that the amount of times that we're asking as valuers for information, be it leasehold information, tenure or EPCs or whatever it could be anything, and we can't get it. I mean, that's going to take us longer to be able to do the valuation. May not help in trying to get to the figures that they want because we're not aware fully of the leasehold or the tenancies in place, etc. So if whatever information could be provided beforehand, that's a massive help. A lot of these valuation packs, there's a lot of stuff in there which I disregard because some of them tend to tell you how they think the property should be valued. I've seen some where there is an actual valuation and saying, here's the comparables, this is what the market rent is, and these are yields because this sold at that. Well, I wouldn't go as far as that, but providing any evidence you want to, even though the value is going to look through their own channels to have evidence may be helpful, but ultimately full tenancy information, a history of the property, if you've undertaken works before and after photos, a costed schedule in there, if they've undertaken those works or if those works are to be undertaken. That's just basic information that provided prior is so helpful.
Yeah, and I guess it just makes your life easier, not in cutting down the work, but as you mentioned, you're telling a story. So if you've got half the content of the story ready to put on there, and you can go, well, actually, yeah, I can see the difference and the uplift in the quality of what it was versus what it is. I can understand now why you believe it to be 100,000 purchase, 50k spent, and now valued at 250. I can see the difference and what you've done and so on. Then surely that makes it easier for you to go, well, okay, this is starting to make a bit of sense now. Can I justify that? Or actually, you're quite off the mark and you start to get a picture in your own mind before you put pen to paper.
Absolutely, and that's really handy to see. I mean, as well, with VAS, we have a 5-day SLA, and sometimes on the 4th day we're asking for information we still haven't had. There's no way I'll have the girls at VAS calling me, wondering where the report is if it doesn't come in. So I'm not holding that back. And if it's, for instance, tenancy information and they haven't provided, I'll state in the report, look, we understand the property's that there is a tenant in place. We have requested the information. It's not been provided. Our valuation is based on vacant possession. You need to do further, or the lender needs to investigate further and come back to us if there's anything material that changes what we've assumed effectively. So it's in their best interest to be able to provide the information up front.
Yeah. So I think the takeaways from that are, don't try and be the valuer.
Yeah, correct.
Stay away from that. Just give the information that a valuer would value to make the job as easy as possible.
Absolutely, yeah.
Yeah, cool. That makes perfect sense on that. And then the other one, and you mentioned just briefly auctions, learning to be an auctioneer, etc., or exposure to that. This is a difficult one because we get it all the time. How can I get pre-approved for my loan for an auction? So when I turn up and buy a bid, I know I'm going to get the money, etc. I get it. I understand what they're trying to do. But the property's not being valued, so we don't know what it's going to be worth. We don't know where your maximum bid is or what you're ultimately going to end up purchasing it for. in your experience, is there anything that buyers can potentially do in terms of auction to try and get themselves in the best possible buying position without actually having an offer on the table, as it were?
In that, do you mean with obtaining a valuation?
Yeah, because there's a reluctance to go and spend money to get it valued. I understand, because they might be outbid and perceived waste of money, but yet there needs to be some due diligence. Otherwise, you're theoretically bidding blind. So,
yeah, the amount of desktops I do for this purpose, there's quite a few, and we're always happy to do that. It can de-risk it somewhat for the borrower prior to auction. And yeah, we get calls quite a bit, and we're in a position in the sort of our South Wales office that we can react pretty quickly as well. So we can turn reports around quickly, which is obviously helpful in this situation. But yeah, I think borrowers speaking to a valuer they know and saying, look, this is going to auction. What's your view on value? I did one the other day actually, and a broker called me. It was probably in the Uplands going to auction. And I looked at it, there was lease in place, and I said, look, I think it was going off as in excess of 450. I said, there is no way that this should be valued more than a red book, a report, I'm going to struggle, I'm not going to get over 475. So they knew where they could get up to in terms of where it would sit. It was a straightforward investment val because the lease was there, I could review the lease before. And I said, look, and they didn't go above that and actually sold for slightly less. And in the end, we sort of ended up doing the valuation for the lender, but the borrower went to that auction with the comfort knowing that ultimately if they didn't surpass 475, then they're potentially it's going to value up with either ourselves or a different valuer post auction, and it could be turned around quickly.
Yeah, I guess actually it probably brings us to a close quite nicely, and I think one of the takeaways or the theme that I'm getting through this is if you are somebody who is active in the property space and are actively looking, and you're not just going to buy one and forget it, it's worth striking up relationships locally with valuers. Because with VAS panel means you can to some degree have a control over that instruction, who wins the instruction, I should say, or gets the opportunity to quote on it, and having that ability to discuss properties before you start putting offers in and doing your due diligence in terms of, do these numbers wash, do that numbers wash? If they can have a conversation with you up front, then that's going to save so much time and headaches. We've covered a lot in this hour. Really, really useful. Spend a lot of time on the investment side of the conversation, which is pertinent given our audience. It's a conversation, as I say, we have all of the time. I like the bit around the valuer packs as well. Don't try and be the valuer, just try and help them as much as you can. That avoids rubbing people up the wrong way as well. Try to tell them how to do their job on that front. So, and the other one then is this point around saturation. I think it's a comment that's overlooked a lot because people just default to numbers. Whereas, look at your product and how much of it, what's the demand of your actual product. Yes, there's a housing shortage, but housing comes in many different shapes and formats, and is your actual product within it something that's got a demand on it? So that's fantastic. Matt, thank you very much for that. I do appreciate it. Thanks for your time and your insight on this one. I think it's going to provide a ton of value, and we'll look forward to catching up in the not too distant future. Awesome. So there we have it. That was Matt Mason of Certus. I think you'll agree he had plenty to share around valuations and his thoughts on it. Super valuable. I know we've covered some of this stuff in the past, but it's good to get different valuers' takes on it. And I don't know if you picked up the same as I did, was very much the view that I would have. So as you can see, it's very much down to the valuer's discretion. So take from that what you will. There was tons of things in there. See what you can apply to your deal. As I sort of summed up towards the end of that around some of my key learns, I think, which were oversaturation is, whilst there is a property shortage, is your property type included in that shortage, and is there a demand for it? When it comes to commercial valuations, looking at the testing of the comparables versus the investment, that was interesting as well. And also the future outlook. As I say, it's something that's been in reports numerous times that we've had a look at. And I've always wondered how that influences things, and Matt covered that off really, really well. So loads to think about, loads to take away. Hope you find that useful, and I will look forward to speaking to you on the next episode. Cheers now. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.